Guys, this is a good one. Pratik knows quite a bit about managing funds and the Indian market, so you should join this one.
I tried to do some startup investing in India and I had a tough time. Obviously, I was participating as an angel investor or like an early stage VC investor, and I really wanted to make it work. But there was just too much bureaucracy and red tape and paperwork. And then on top of it, just the tax situation of trying to get your money back out and so on. It was just too difficult. And it's not that it's like impossible. If I had no other opportunities to invest, then I would still soldier through it. But I have opportunity costs. And so it basically takes away the top of the top investors out of the market for cross-border funds and international. So it ends up being a local player's game. I hope there's enough local capital, but international capital, it's hard to get it in through the door and even harder to get it back out.
Have you invested in companies that are in the US, like incorporated in the US, but have their team and offices in India?
I'm referring to companies that are actually based out of India. Like the whole team is there. They might have like a US investment entity, but it doesn't quite do the job. They're still basically headquartered and run out of India. So the master company's in India. Examples are Chingari, Ku, Agnikul, E-Plane. There were a few others.
Having spent well over 12 plus years managing an equities-oriented fund, buying listed companies in India, I fully understand and appreciate the sentiment. There's a couple things that some folks maybe don't know, specifically around the public markets, and that is that I'd say more than 50%, and I'd venture to say even 70% of the market cap of all Indian equities, we're talking about 6,000 plus listed equities, are owned by foreign institutional investors. So foreign and international capital definitely plays heavily in India. And you have a pretty robust regulator, and laws and a framework based on British common law. So that's helpful. And it is a massive pain in the butt to get your money in, a lot less so to get your money out, ironically. And the accounting system is based off British chartered accounting. So there's a base level of transparency that exists. On the startup, venture, and PE side, it is a massive pain. It's not simple to get stuff in and out, and it's definitely not as simple when you compare it to a developed market like the United States. However, when I look at so despite all that, and then there's the big risk which people frequently overlook when looking at India's opportunity cost, as Naval mentioned, but it's that you also have a huge currency risk there as well. And so, when I started investing in India, the Indian rupee was trading roughly at 40 rupees to $1. It's closer to 80 right now. So if you haven't doubled your money in Indian equities since the early 2000s, or 2005, let's just say, you've actually underperformed or lost money on a relative basis in your home currency. So that's something, and it's very, very difficult and quite expensive to hedge your Indian rupee exposure. And how do you hedge Indian rupee exposure in a startup or in a private equity type investment? It's very complex. Despite all that, the reason I kind of brought this topic up is that when I look around the world right now, we're one of the few markets that you have actual real demand. When you look at Europe, when you look at the United States, when you look at the rest of the developed countries, or even emerging markets, specifically China, which it's questionable if that's an emerging market or not. Where is there just a baseline level of real demand? And India is one of the few places that actually has it. So when you look at that, it's like, okay, you know what? Maybe that in and of itself makes it worthwhile to kind of bite your lip, grind the teeth, and kind of soldier through and figure out what we in trading used to call an angle to the tangle to get this thing figured out. Love your thoughts. To put it a little bit more succinctly, the rest of the world has too much capital, not enough demand, whereas India has too much demand and not enough capital. So if you have capital, and it's intuitive, or it would make sense that you would get handsomely rewarded for providing capital to a market there where there's tons of demand for it and high returns on that capital.
Thanks for the thoughts, Pratik. I hadn't even taken the currency risk into account, so there's another one. As a quick aside, you're better off recording shorter chits on this platform if it so behooves you. They go more viral, they're easier to share, easier to stitch, easier to re-record, etc. Try it out. Back to the topic at hand. Angel investing is a local game. If you're not the local, you're probably getting bamboozled. So it's really hard to do cross-border, and then all the additional bureaucracy, red tape, getting your money in and out, and then finally the currency risk and taxes just mean that it's not worth it. If the Indian government wants to encourage real innovation, investment to come cross-border, maybe they don't need it. Maybe they have enough in Bangalore and Mumbai and Delhi. But if they really want it, then they really need to lower the red tape and the taxes and make it easy to get money out. Currency risk, I think at the end of the day, I could deal with if that was the only one, but I can't deal with that plus tax plus regulatory. I'm not whining at you. I'm just stating a fact.
Is the tax situation something that may change in the near future with the current administration there?
I kind of have a variation of the same question. We hear about how business-friendly Modi's administration is. So is this even on their radar? Is this something they care about? Or it's just too small potatoes for them?
This is urban land I own in India. I have no clue how I'm going to get the money out. I just got it fenced, just cleaned up the paperwork. More to be done. I don't know how I'm going to pull out the money, but it's prime real estate. It's kind of like owning the Times Square of Philadelphia, but in India.
I'm a little perplexed by the points on taxation. Foreign investors for long-term capital gains actually pay zero long-term capital gains tax. And I believe short-term, which is 2 years or less, I think the tax rate is 10%, especially if you're domiciled like in one of these common offshore jurisdictions like Mauritius, Cyprus, Singapore, and so on. And with respect to getting your money out, India is actually very straightforward in getting your money out. It's getting your money in and getting all the registrations as a foreign institutional investor and the various instruments that you want to actually invest in. That's where it gets a little complex, especially with all of the requirements around KYC, OFAC, a certain minimum size of account, and so on and so forth. But once you're actually investing and trading in India, we were able to literally wire hundreds of millions of dollars out within 24 hours, no questions asked. Naval, as you said, angel investing is a locals game, right? And the TLDR in this entire thread, I think, from my perspective, buy the ETF. You'll get most of the market beta. You'll get most of the earnings growth and all the demographic dividends and everything else. If you're looking for that needle in the haystack, you're likely to be outfoxed by local operators trading in illiquid assets that are just ripe for manipulation. So buy the ETF, be happy, and focus on your home market.
Pratik Sharma, so good to see you here, brother. Small world. Welcome to Airchat. Good invite, Kumar. So I'm going to break this into a few chats. First is going to be why India. I personally have very minimal, if any, direct exposure to India, startups, equities, or otherwise. However, it's not for lack of conviction or trying. I, over the last 15 years, have wanted to have some exposure there. And the thesis underneath why India for me is nothing other than the powerful forces of demographic trends. If there's one thing we've witnessed in the States, studying the specific snapshots of demographics, such as the baby boomers, has been a greater driving force than any other I've known over 30, 40, 50 years. And for India, for me, that looks like a very balanced population bell curve listed, if you look at the y-axis being age, of a young population that is motivated and growing. And by studying that tidal wave, I believe there's at least another 20 years. Now, of course, this is outside of the thesis in Modi and the current government just continuing to add fuel to that. So independent of, again, what your view is, it has clearly been good for business and technology and startups and value creation. So for me, there's a strong yes over the next 10 to 20 years on the macro demographic forces driving a much stronger tailwind behind India than not. And lastly, I wanted to let you know, Pratik, you may find a couple other rooms I set up of interest. I set up one on hedge funds, just based on some comments in Market Madness that I think you could probably contribute to. I'm going to be adding a lot more to that in looking at the evolution of the industry over the last 50, 60 years. And then I also set up one called Investing Dojo, which was originally inspired by some healthy discussion on NVIDIA and based on a new investor coming in. I decided to go down the rabbit hole of condensing a couple dozen years of professional investing into a couple dozen chits. It wasn't intended to be that way, but I'm sure you could add and contribute to that. Would welcome your thoughts. Again, it's called Investing Dojo. Look forward to connecting more on here. See ya. Second is how India, the difference between listed equities and venture capital, I think is quite significant. And more specifically, I believe, as has been said earlier, there are a lot of idiosyncratic challenges in navigating time zone, culture, the way business is done locally, the bureaucracy, all of that. So personally, I've avoided direct startups. Having said that, it is something that I do believe has continued opportunity with the right resources, team, and or network supporting that. So I believe the default path is liquid versus illiquid. Having said that, as you pointed out rightly, you do have a headwind of currency to make sure you can at least exceed. So, a USD denominated ETF to me is kind of the baseline hurdle to exceed. And I don't know how those compare to, say, the Nifty. So the alpha that's required to compensate for the multitude of risk factors in going startup versus an index, a liquid public index, that is, I think is quite significant. So I think that's its own set of challenges that require that. But curious to see if you've only been doing it versus with liquid exposure versus illiquid exposure.
At least my experience of the one exit I had there was that I had to leave huge amounts in there for potential taxes, and there was all kinds of certifications required, and there were all kinds of wires I tripped because I don't know, I was a certain kind of entity and not another. And when you're an angel investor, that kind of stuff is just too confusing. You don't have time to think about it. You don't have an army of lawyers. You don't have an army of certification agents, and everyone you hire in India is mired in bureaucracy because they're dealing with a government bureaucracy on the other side. So I know it might be straight for someone who runs a hedge fund and maybe wants to make a career out of investing in India. But if you're an American investor and you want to dip your toes in the water, forget it. Yes, I think that is good advice.
One thing that's extremely exciting about India is they took the number of days for fiber optic permits from 416 or 460 days down to less than 20 days. I think it's 16 days to get your fiber permitted. They've also capped the fee that you can pay to the government to permit it to be there. So there's a certain dollar amount per a meter or per 10 meters or something like this. So that's really exciting as far as the proliferation of broadband, fiber optic, fixed wireless access, and 5G. Now, that was rolled out last year. This year, I think they're going to be rolling out some sort of regulation or one portal where you can do all your 5G permitting. So they're leapfrogging certain things that we have in the US that are onerous.